This is the covered calls number 3. We're going to review today and go into a lot more detail on things. First off, bid ask. Bid is buy, ask is sell. We're going to go into the option chain, a lot more depth into that, and how to pick strike prices. And then the Greeks. The Greeks, they're Greek symbols that symbolize certain things with options. And there are 5: delta, theta, gamma, vega, and rho. Delta represents sensitivity to an option strike price, or sensitivity to an option's price. Theta represents the passage of decay, the time decay of an option. Gamma is the rate of change of delta. Vega is sensitivity to volatility, and rho is sensitivity to interest rates. Now, of these 3, delta, theta, and vega are the most important. By rank of importance is delta, vega, and then theta. All right, first we'll talk about delta. Delta is based off statistics and probability. All right, let's go back a little for a second. A way to explain this is options are like a car, and you ask me, how does this car work? And I open the hood and I say, well, here's your engine. Well, Greeks are your engine for your options. Now, inside those Greeks are things that make them more complicated. There's mathematics, there's the Black-Scholes formula, there's probabilities and bell curves and all kinds of other stuff that make the Greeks work the way they do. But what you need to know is that the engine is there and how it makes the car move. So the Greeks, we want to see what they do, how to understand them. We can read them on the option chain, and what they do to price, and what changes in them will do to price. So first off is delta. Delta is basically what happens to your option price when the stock price moves. And you can also look at it as probability of the stock price moving to a certain point. So from $10 to $15 movement, what is the probability? The delta will tell you that. This helps you pick your strikes. So you pick a strike, Ford's at $11. What's the probability that it's going to $12.5? We can see that. We can see the exact probability. That is the delta. And pick which strike to use, the 12.5 or the 13. Because there's less probability at the 13 than there is at 12.5. By using these probabilities to pick the strikes, we can have high confidence our plan will work out. So we can even go out to 90%. You can customize your option however you want and use as much risk as you want, but you got to balance that with the returns of the premiums. Theta, time decay. This is how selling options, selling covered calls makes its money. The passage of time lowers the options price as it approaches expiration. So the more time you have, the more premium you get. Then as that time ticks away, and the closer you get to expiration, that premium is going to be lower and lower and lower. No matter what everything else does, delta, vega, the stock price, theta will eat it all away. If you're on the wrong side of this, it's horrible. But if you're selling options, it's on your side, and it's a great thing to have. Because over time, as we get to expiration, that premium is going to go to 0, which is good for us because we're selling that. We get the premium and we don't have to pay it back if the faster it goes to 0. Vega, implied volatility. The higher volatility, the higher the price of the option. Lower volatility, the lower the price of the option. A good example here is the earnings crush. For instance, we have Netflix giving earnings this afternoon, and their volatility is going to be very high today because of the uncertainty in their stock price of the earnings release tonight or this afternoon. Their option prices are going to be inflated. All of them are going to be inflated. So if you're selling covered calls on Netflix, you're going to get higher premiums today. It's probably going to be one of the best days to sell covered calls because tomorrow implied volatility is going to drop on Netflix. Earnings volatility crush. So that is going to make it good for us. We sell our option high, and one day later the option price is really low. We can buy it back for lower and keep that money and only have it a day. So here I have a little bar chart all in here. These are the Greeks, and they kind of stack up in a little bar chart all to equal the option price. The number one is the stop price. How that moves changes your option price, of course. Theta, Vega, Gamma, Rho. Each one of these can move on their own and change the option price. So if you were on the other side buying a call, you're speculating that the option is going to go up. Let's say we're on Netflix earnings today, and I say, hey, I think Netflix is going to do good. I'm going to buy a call on Netflix, and I hope earnings comes good. Well, what can happen to you, and what you need to know in the options is tomorrow that earnings can go up. They can have a surprise up, and the stock price, you're like, the stock price is going to shoot up. Well, because of implied volatility earnings crush and the implied volatility dropping, your option price might not go up, and so it don't make sense sometimes. You got to think about all these different factors and what's going to happen. Is when I say option premium, I'm talking about the option price. That's what we call the option price when we're selling covered calls, or when you're selling a call or a put. It's the premium you receive. Just wanted to clear that up. I know I've said it several different ways, and it might be confusing. So going into the options chain again, this is a picture of, so I can write on it, of Webull. Again, this isn't the strike price. These are how many days to expiration. Each date you click on here has its own options chain in there. And what date you get determines, what options chain you're going to use. Now, you ask, what date should we even use? Well, if you're trading, if you're day trading, you might want to do the shorter days, 4 and 11, or even a 0 or somewhere in that range. And because you don't have a lot of most of the action you get in those options is from price movement, and the theta's already ate away. But remember, if you got 4 days left, your theta is going fast. You're on a timeline. You don't want to be holding that overnight. Now, with my personal trading that I have now, I have my stuff's into November SPY puts, and each day it's not dropping that much because of theta. I have a lot of time for things to move. If like this week, the market has moved against me bad, and it's hurting, but it didn't completely wipe out my option yet. We might approach that, but I still have a chance of coming back because we have a lot of time to go. Even if we went to the end of October, I'd still have time. So in the long term, you want to stay out 28 to 45 days to expiration. So we're looking 25, 32, 39, 46, that range. You get over that, you're kind of pushing it out. Your returns might not be quite as good for what you're putting into it. All right, so now let's break down into one of these these days, and we're in the November 11th. Like I said, these are your option prices, the bid-ask spread. Once you pull up that order, it's going to show you the exact number that it's trading at. You have to do a limit order, and if it's not getting filled, then you're not you need to move the price around a little bit, lower it or raise it a little bit just to get it filled. All right, next I'd like to show you over here, when we move to the right on this chain, it'll show you implied volatility, delta, and theta are three important things we want to look at. So as that changes, you can keep track of these things, or even look at charts of these different implied volatilities, and it'll show you it'll give you an idea on what's going to happen, the way you can predict price. For instance, the earnings crush. The deltas are the probabilities that it's going to be in the money. All of these options are already in the money, so the probabilities are very high, 89%, 90%. There's only a 10% chance that it's not going to be in the money. And then $5, it's not happening. They're saying $6, it's not happening either with this volatility. Ford, you can basically count on, at this price here, Ford is not going below $8. It is not happening. It hasn't happened in 20 years. All right, now let's look at the thetas. It's not a good view of that, but as you see, it gets closer to expiration, those thetas rise. So every day that goes by, you lose that much on your premium, so that the price of the option changes by point. For here, down here at the $10, the price changes 1.1 cent, or 1.1 cent per day. It'll drop. That's important to know, because every day you let these options go by, the time brings the price down. All right, now let's go to Webull and look at the real option chain. This is live feed. Again, it's 11 to this morning, and we're looking here. If you'll see where it's green here in the middle of the page, it says ITM. That means in the money. So your stock price is above all of those strike prices over there. That means those are in the money. If you ever hear out of the money, that means the strike price is above the stock price, and it won't. When the stock price is below your strike price, you will not have to sell your stock. Now again, you can scroll over, you can look at your implied volatility. Also of note, you want to look at your open interest. So last week, here's a story. I got in Carvana. I put a put on Carvana, and I did not look at open interest. I was expecting the CPI numbers to come out, and Carvana I expected to drop. Well, it did drop. The CPI numbers came out, and Carvana dropped 10%. However, my option did not drop quite as much as I had hoped. It only dropped 5%, or I'd only gained 5% because the price of Carvana dropped. And I'm like, what is going on? This is crazy. Why ain't this working? Implied volatility, yes, that dropped, but it still should have. This is a 10% drop. That worked. So two things hurt me. One was implied volatility dropped. It was basically an earnings crush situation. The other thing is I didn't have no open interest in this option. I had picked a month away on Carvana, and there wasn't but like 6 contracts of these, and I held one. Nobody was trading these contracts, so that didn't update the prices. Yes, the price probably was higher. So what I'm doing now to fix this situation is, I still believe Carvana is going down. They've gone up this week, and I'm losing a bunch of money in my position, but their earnings is coming
November 4th, and I think that the implied volatility rising will increase the value of my put, and I'll eventually be able to get out at a better price because we'll have more volume traded on that option. So you want to look for good open interest and good volume on both your stock and your option. All right, so you want to, all these things, theta, you just need to know over time the price of the option is dropping. How fast that happens depends on a couple things: how close we are to the money, how close we are to expiration. The other thing, the big thing, is implied volatility. That will hurt you. The deltas are mainly your probabilities. There are even ways to do what they call a synthetic stock ownership. If I bought Ford at $11.98, it cost me, we're at $1,200 for 100 shares. I can go down and buy an $8 call 4 months from now, and that $8 call is a 97% chance it's going to be in the money. That is just like you own the stock. It's going to move the same way. It's valued the same way. The brokerages see it that way. You can actually go and buy a long-term put, or I'm sorry, you can buy a long-term call on one of these deep in the money options and sell covered calls on that. That sounds crazy, but it's you get a higher return because you don't have to pay as much for the stock, the underlying. Anyways, guys, I think this about covers everything. If you got more questions, let me know. We'll try to cover those too. All right, have a good one, guys.